Welcome to our series of educational videos on technical analysis. This is part 4, Indicators. I'm Michael Gable, Managing Director of Fairmont Equities. Please ensure you are familiar with our disclaimer in that any advice is general advice only. The first part was an introduction. Part 2 we looked at charting patterns, and then in part 3 we looked at candlestick reversals. In this part I'll show you a few indicators that can be used to help your trading, along with some practical examples. Later on in parts 5 and 6 we'll go through Elliott Wave and how we combine both technical and fundamental analysis. For those not familiar with us, Fairmont Equities is a share advisory firm helping clients achieve higher returns from their share portfolios by combining both fundamental and technical analysis. You may have seen some of our commentary in the specialist media, such as the Financial Review, and I regularly provide commentary on the Sky News Business Channel and CNBC. We have previously looked at the way pricing patterns can give us an insight into how a stock is trading. Indicators go a step further and use price and volume to derive other measurements such as volatility and momentum. We have to remember that they are derived from price and volume, so they play a supportive role. We can't make trading decisions based solely on an indicator. Some indicators are leading, such as the Relative Strength Index, and some are lagging, such as the Moving Average and the MACD. Many other indicators exist, of course, such as Bollinger Bands, stochastics, average true range, etc. But I won't cover off on all of them here. I encourage you to read up on each of the others and try them out, and then do some back testing to see which ones suit your style of trading. The first indicator that we will look at is the RSI. It is a momentum indicator that measures the speed the share prices are changing. It does this by comparing the recent gains and losses over a specified time period. We normally use a 14-day period. The RSI is converted to a number between 0 and 100. A reading above 70 suggests that a stock is overbought. If it then drops under 70 again, it triggers a sell signal. A reading below 30 means that it's oversold, but once the RSI moves back above 30, it triggers a buy signal. Looking at an example here, this is a daily chart of Lendlease. We can see an example of a sell signal and then a buy signal. So here's the sell signal here, and here's the buy signal. The stock moves above 70 on the RSI and dips under it, right here. Then the buy signal's triggered as the RSI goes under 30 and then heads back above it. You will notice that there are other turning points in the stock where the RSI didn't hit those extreme zones, such as up here, and then once again down here. So as I've mentioned before, it's a useful complementary tool, but it cannot be used in isolation. The moving average is a very common trend following indicator. It helps identify support and resistance in a stock price. It is essentially calculated by adding up the closing prices of a stock for a specified period and then dividing the sum by the number of observations. Can be easily customized into any time period that you like in order to fit your strategy. However, the 50 days and the 100 days are the most common used averages. Two moving averages are usually plotted at the same time to determine crossover signals, with one being a shorter time frame than the other. A buy signal gets triggered when the shorter average crosses over the larger, and a sell signal when it moves back under. So let's have a look at an example. This chart of ANZ is overlaid with a 50 and a 100-day moving average. The blue line is the 50-day, and we can see it crossing up here, generating a sell signal. It keeps you out of the trade all the way until it crosses back over again down here. Another way to trade the moving average is to act when the share price itself crosses the line. So for example, you can see here that the share price of ANZ went under the 100-day moving average, but we can also see it hitting back above it momentarily here and here, basically giving us a couple of false buy signals. Like most indicators, you just need to experiment with all the different parameters to eliminate a lot of the noise in the system. So the shorter the time period, the more noise that you have. The MACD is also a momentum indicator, which shows the relationship of two moving averages of prices. The MACD is calculated from subtracting the 26-day exponential moving average from its 12-day EMA. The signal line is the 9-day EMA, and that's plotted on top of the MACD, and this line will identify buy and sell signals. So let's have a look at an example. So this is the MACD for Origin Energy. Now, one key point to bear in mind is that it's not very effective in sideways markets. So this is a weekly chart, and you can see that on this weekly chart, as Origin was just meandering around back across 2013, 2014, the MACD down here, it wasn't really indicating strongly whether we should be buying or selling. But once we do get a decent move in the stock, and you'll notice that it started falling away here, when we come back to the MACD, we can see some very neat buy and sell signals. So once it got moving here, there was a buy signal, another sell, and that kept you out of the trade from around $11 all the way back down here when it was trading at about $5. That's the end of part 4. In part 5, we'll look at Elliott wave analysis. If you're not viewing this video on the Fairmont Equities website, be sure to pay us a visit where you can subscribe to our research and see our real stock picks in action. There's also a free blog page that does get updated regularly with my articles and videos.